Have you ever found yourself puzzled about the right moment to enter or exit a trade? What makes one trader consistently successful while another struggles with losses? What if I told you there are precise entry and exit points that can make all the difference in your trades? Hello friends, in today's lesson, I will answer all these questions and equip you with the knowledge you need to reach your trading goals faster. All right, let's start with entry points. Imagine them as the starting line of your trade. In trading, an entry point is a specific price level at which you begin a trade. Now, there are two types of trades: buy, also called long, and sell, known as short trade. When you open a buy trade, it means you expect the price of a currency pair to go up. So you start a trade by buying at a set price. On the other hand, opening a sell trade indicates that you anticipate a price drop in the currency pair. In response, you enter a trade by selling at a particular price. Now let's try to understand exit points, the finish line of your trade. Predefined exit points help you decide when to close your trade, and there are two primary types: take profit, TP, and stop loss, SL orders. Choosing between them depends on your assessment of the risk and reward ratio of the trade. A take profit order is like setting a target for the profits you desire. It's a predefined price level at which you close your position to secure your profits. On the flip side, a stop loss order acts as a safety net. It's a predetermined price level at which you close your position to minimize potential losses. Think of it as protecting your capital, just like wearing a seatbelt while driving to stay safe. You know what? Exiting a trade is like leaving a party. You want to slip out quietly without anyone noticing, especially the market, which has a way of making a whole scene about it. Moving to the next segment, let's discuss the importance of entry and exit points. Think of entry points as the gates that allow you to enter and exit the market at precisely the right price levels. A well-chosen entry point can mean buying low and selling high, significantly increasing your chances of making a profit. Similarly, a thoughtfully selected exit point is your key to locking in gains or limiting losses, ensuring the preservation of your capital and maximizing overall profitability. In other words, entry and exit points are your secret weapons for balancing the scales of profit and loss. Now, before moving ahead, here's a question for you. Why did the currency go to school? To learn the ABCs. Always be checking for entry and exit signals. Now let's discuss the second benefit: risk management and emotional control. Trading isn't just about numbers, it's about emotions too. Here's how predefining entry and exit points can help you manage risk and emotions. The trading journey can be a roller coaster of emotions, which often leads to impulsive decisions driven by fear or greed. But by setting predefined entry and exit points, you can stay disciplined and avoid those hasty decisions. Take profit and stop loss levels act like a safety net. They protect your capital by automatically closing positions when the market moves against you, limiting potential losses. In essence, they help you take control of your emotions and make rational trading decisions. Now move to the third benefit of predefined entry and exit points. Predefined and strategized entry and exit points offer you a systematic and structured approach to your trading strategy. By adhering to a strategy that includes these points, you can fine-tune your decision-making process, reducing guesswork and increasing the likelihood of success. This disciplined approach contributes to improved trading performance and consistency. You can objectively evaluate your strategies and adapt them as needed, continually improving your trading game. Question time, friends. Why did the currency cross the road? To reach the other trend line. It was a bullish move. Moving on to the next segment, let's discuss how to find entry and exit points. Our first stop on the journey to pinpointing entry and exit points is technical analysis. Think of technical analysis as learning the language of price movements. This method involves studying historical data such as price charts and utilizing various indicators and tools. Traders use technical analysis to identify trends, support and resistance levels, breakouts, and reversals. These patterns and signals can be your guiding lights when it comes to determining favorable entry and exit points. For example, if you spot a pattern indicating a trend reversal, it might be a good time for either an exit point to secure profits or a new entry point to initiate a trade. Next up, we have fundamental analysis, which delves beyond the charts and into the heart of economic, political, and social factors. Traders who use fundamental analysis keep a keen eye on events like interest rate decisions, inflation reports, GDP data, trade balances, and geopolitical developments. These fundamental factors can provide valuable insights into potential shifts in currency values. For instance, a positive GDP report might indicate a strong currency to consider a buy entry or exit point. Conversely, a central bank's decision to reduce interest rates would indicate a declining trend in currency price, leading traders to select a sell entry or exit point. Before moving ahead, you guys have to answer this. It's an easy one. Why did the Forex trader become a detective? He had a knack for solving mysteries, especially when it came to identifying the right entry and exit points in the market. Lastly, we have a sentiment analysis, a fascinating exploration into the collective mood of traders and market participants. This method involves tracking surveys, polls, news, and social media to gauge the overall market psychology. By understanding the sentiment of the market, traders can identify potential opportunities and risks. If the sentiment is overwhelmingly positive, it might indicate a bullish trend, suggesting a buy entry or exit point. On the other hand, if sentiment takes a negative turn, it could be an indication to consider a sell entry or exit strategy. Now let's explore various tools that traders use to pinpoint entry and exit points in the market. Number 1, moving averages. Moving averages smooth out price fluctuations, revealing trends. Look for the crossovers or pullbacks to spot potential entry and exit points. Number 2, Bollinger Bands. These bands with their middle line as a moving average help us assess volatility. Keep an eye out for squeezes or bounces. They could be indicating key entry or exit points. Number 3, MACD, Moving Average Convergence Divergence. MACD reveals the difference between moving averages, giving us insights into momentum and trade direction. Watch for divergences and crossovers. They might be pointing to entry and exit opportunities. Number 4, Ichimoku Kinko Hyo. This comprehensive tool provides a wealth of information. Cloud breaks, Kijun Sen crosses, and Chikou span confirmations are just a few components of this tool for potential entry and exit points. Number 5, Stochastic Oscillator. Is the currency pair overbought or oversold? This tool helps us find out. Look for potential reversals in the market using overbought or oversold conditions to guide your entry and exit decisions. Number 6, Relative Strength Index, or RSI. RSI measures strength or weakness relative to recent price movements. Keep an eye on overbought or oversold conditions. They could indicate potential reversals and guide your entry and exit strategy. And there you have it, friends, the essentials of entry and exit points for successful trading. If you found this video helpful, don't forget to like, share, and subscribe for more valuable content.